Hi there, welcome to Kneppy Invest. I hope you're having a great day. And today I'm going to go on a rant, all in fun, because even though some might say the ranting is therapeutic, and when I say some might say that, I'm just talking about myself, because research has shown that overdoing ranting, particularly in social media, does have negative health effects. So I'm hoping you're not the sort of person who is ranting online all the time. Now, this is just all in fun, but there is some serious undertones to the rant I'll be talking about in today's video. And I think I have the perfect media to go on this rant. But today's rant theme is overweight banks. Now, this will not be a fat phobic rant, even though I do think it's good to be healthy, good to be fit, and not obese and overweight. But you could say that the banks are fat with money. Now, what I'm talking about in regards to overweight banks is those people with a portfolio that consists of 70% banks. I've also seen some fund managers who I would consider overweight banks. And I have seen a few people's personal portfolios, and whenever I see them overweight banks, I just want to say something, but I'm always a little bit wary because it's not really my business. Not only it's not my business, I can't give financial advice. And in fact, not only will there be one rant in this video, I'm going to actually do two rants in this video. And my second rant is just ranting about myself, ranting about my first rant. And that will make sense when I get to that part of the video later on. So in today's video, two rants. The first rant is in regards to people being overweight banks. Again, none of my business, but it still gets me a little bit frustrated, a little bit, why would you be doing that sort of feeling? And I've got to try to not feel like that when I see other people's portfolios, because again, it's not my business. If you find it comfortable to be overweight banks, to have 70% of your portfolio in banks, that's your business. Because I do believe it's very important to be able to find your own light. And I'll talk about what that means later in the video. Now, you might be wondering, why am I so against people being overweight banks? And I shouldn't say against, maybe that's not the right word. Well, I would never do it. I would never be overweight banks. I would never have 70% of my portfolio in the banks. And not only that, I have also seen people's portfolios have, say, 60% banks and also have Woolworths, Telstra. And it seems like all they've done is pick the slowest growing companies on the ASX and put that in the portfolio. And these type of companies actually underperform the market. And you could even argue they significantly underperform the market. And I do have some facts to back that up in the next slide. Now, an argument that has been put forward to me is that banks are safe and stable. That's not true. In fact, by their very nature, banks are fragile. But you want facts. You want some facts to back up my argument that banks underperform the market. In fact, my suggestion would be, and I can't give financial advice, but this is just general advice, that if you do have a portfolio that is overweight banks, just put your money into an ETF, because then you do get access to those faster growing companies on the ASX. So like the ASX 200, Vanguard, VAS, whatever it's called, just buy that instead of the banks. And here is the proof behind my thinking. So what I did is simple screener, and this I believe is through Guru Focus. And I have 5 columns of particular importance. So my screener in for this particular video was simply those ASX companies with a market cap above $5 billion that have been listed for at least 10 years. And then I ranked the companies based off their annual returns. And annual returns is the share price increasing or decreasing plus the dividends. So that's my ranking in regards to these 67 companies that were successful in this particular screener. Market cap $5 billion, listed for 10 years, and ASX listed. The other five columns here include revenue per share growth over 10, 5, and 3-year periods. Also, return on invested capital. The reason I look at revenue per share growth and return on invested capital is because every single time I research a company, those are the things I look for. First things I look for is revenue per share growth over 10, 5, 3, and trailing 12 months. And I also look at either return on equity and or return on invested capital. And I'll talk about why in a second. I've also included 5-year annual returns. So these are the 20 worst performing companies on the ASX over the past 10 years that has a market cap above $5 billion and have been listed for that 10 years. In fact, only 4 companies among the 67 companies had a negative total annual return. Those 4 companies were Yancoal, Santos, Worley, and Origin Energy. And there is a common theme behind or for all 4 of those companies. And that theme, of course, is their mining services, that sort of area, which is not a surprise. We know mining is cyclical. So some of these companies will perform really well over short period of times. In fact, Yancoal in the past 5 years has an annual return of 12.66%, but over the last 10 years, negative 5.5%. So there will be periods of time to own these sort of companies. In fact, all 4 of those companies have positive returns over the past 5 years. And then just behind these 4 companies, we have Lendlease, Westpac, and then ANZ. And further down the list, we have Telstra, which is very common among people's portfolios as well, and also National Australia Bank, and down the bottom, Woolworths. So those 6 companies are fairly favored among retail investors on the ASX, yet most of those companies have a very have had a very mediocre return, annualized return over the past 10 years. Now, what's the relationship between the annual return we have seen for these companies and revenue per share and return on invested capital? So what I'm looking for is high quality companies, and none of these companies on the list I would classify as high quality companies, which means I will never invest in any of these 20 companies for the long term. And the way I filter out these sort of companies is I look at revenue per share growth and return on invested capital or return on equity. For revenue per share growth, I want at least 10% per year. And in fact, for most of these companies on this list, they have had actually negative revenue per share growth over the past 10 years. In fact, I'd say 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. 13 of these 20 companies have had negative revenue per share growth over the past 10 years. And I've also included 5 and 3 years, but that's just something I look for every single company. Yancoal, revenue per share growth, negative 23.2. Santos, negative 2.2. Worley, negative 6.7. Origin, negative 4.3. Westpac, negative 1.2. ANZ, negative 0.9. National Australia Bank, negative 9.9. In fact, the only 2 companies with close enough to being good revenue per share growth are Scentre Group and Stockland Corp. And I believe both of those are real estate companies whose share price have suffered over the past year because of rising interest rates. Now on to return on invested capital. The way to look at return on invested capital and return on equity is that's the greatest you might see your returns for that company over a certain period of time, over the next 5 or 10 years. So if you see a company with a very low return on invested capital or return on equity, more than likely their forward returns are going to be mediocre. And in fact, if you look at these 20 companies, there is not one single company with return on invested capital greater than 6.59. In fact, most of these companies on this list have a return on invested capital between 0 and 3 or 4. Now, the banks don't have a return on invested capital, so I don't look at return on invested capital for banks. And some people might look at a return on equity, but I like return on invested capital because it's a little bit more conservative because it includes debt than a return on equity. So when I am looking at return on invested capital, I am looking for those companies with return on invested capital or return on equity greater than 10. And again, all these companies have a significantly lower return on invested capital than 10. In fact, most of them a return on invested capital less than 5. So it should not be surprising. In fact, my head's right over the limit that the best performing company out of these 20 worst performing companies only had an annualized return of 6.15% per year. And to be honest with you, well, I shouldn't say we should be aiming. I aim for at least 10% per year return for my investments. And that's another reason why I would not invest in any of these companies. And if you look at a chart for any of these companies, you probably would not like what you see. Not the sort of charts you would invest or want to invest in for the long term, not the sort of chart you'd like if you're a shareholder of these companies for the long term. And it all comes back to this. Why, and this is my question, I just want to ask everyone who is overweight banks, why would you just not buy an ETF? Because banks, Woolworths and Telstra are among the 10 biggest companies on the ASX, and you're getting mediocre returns. And that means by having the most of your portfolio in those worst performing companies, your overall total performance of your portfolio more than likely will underperform the market. Because in an ASX 200 ETF, you also have those quick growing companies on the ASX that not many people are invested in. So that is the advantage of an ETF, that you also include those quick growing companies that are going to outperform the market. So that's the only thing I would suggest to people is if you're overweight banks, why not just think of putting your money into an ETF? And an argument I have been given and have heard is that banks are safe and they're stable. In fact, that argument is furthest from the truth. In fact, banks, by their very nature, are unstable. In fact, all you have to do is Google or Wikipedia financial fragility. So I'm just going to talk about this ad verbatim, what it says in Wikipedia. So financial fragility is a vulnerability of a financial system to a financial crisis. So over the past 120 years, if you go back and read about any sort of financial crisis we have had, not only Australia, but also overseas, in the United States, whenever we have had a financial crisis, we have seen many banks go under because they are fragile when we do go through a crisis. Franklin Allen and Douglas Gale defined financial fragility as the degree to which small shocks have a disproportionately large effects. Roger Langanoff and Stacy Schreft write, in macroeconomics, the term financial fragility is used to refer to a financial system's susceptibility to large-scale financial crises caused by small, routine economic shocks. In fact, we saw this not long ago with the Silicon Valley Bank, and was it first, well, and a few other banks also in the United States. A small economic shock caused one of these banks to go under. And you might say, well, this will never happen in Australia. Westpac was bailed out in 1990 by the government. It can happen here. Another argument is, well, banks are safer now. They have better capitalization, that sort of thing. And the only thing I would say against that is, even though history doesn't repeat, it often does rhyme. And even if we think banks are safe right now, we just don't know what's going to happen in the future. So when we do go through a significant financial shock, the banks will suffer, and there is a possibility that one of the other banks, the 4 major banks on the ASX, will have to be bailed out. And if that does happen, more than likely you won't want to be a shareholder of that bank, because if you are a shareholder of a bank in those situations, you are going to be absolutely screwed, just like Silicon Valley Bank shareholders were. Depositors weren't screwed. It was the shareholders who were absolutely screwed. So just remind yourself that if you are overweight banks, that if there is a financial shock to the system, banks are extremely fragile. Now, in saying all of that, and I do feel a little bit better now because I have ranted, and it has been said by some, me only, that the best sort of rant is ranting against yourself. And that's what I'm going to do now, because it's none of my business what you do with your portfolio. And this comes back to finding your own light. Not only does this work for your investing strategies, this works in everything within your life. Find what works for you. Find the job that works for you. Find the religion that works for you. And if no religion works for you, find or become an atheist, that sort of thing. But just find your own light. And investing, there are numerous investing strategies. There is not one strategy that fits all. And this is very important because if you listen to podcasts like I do on every single day, if you read articles, listen to fund managers, that sort of thing, you will see and hear quite often that there are professionals out there who say that their way of investing is the only way to invest. And I want to make clear this point. They are wrong. There are many ways to invest, and their way to invest may be right for them, but it may not be right for you. In fact, it may be completely wrong for you. So find an investing strategy that works for you. If you are comfortable with having 70% of your portfolio in the banks, that's fine. That should be fine for me. That should be fine for everyone else out there because you are comfortable with that strategy because that strategy works for you. So even though I've gone on a rant about people being overweight banks, that could be a valid strategy for you. So it's very important to find your own light. Find that investing strategy that works for you, and you alone can discover what strategy works for you. None of these professionals can do it for you. You have to find your own light. And that's all I have for this Kneppy Rants video number 1. I think I'm going to do this a little bit more often. I like going on these rants because I've already got the next one set up. It's in relation to a couple of podcasters who are completely wrong when it comes to technical analysis. So look out for that. More than likely we'll release that in the next 2 or 3 weeks. I just want to hiccup. Next 2 or 3 weeks. You don't have to be a genius to know who I'm talking about because I've discussed it briefly in a video or recent video. Anyway, if you think I'm completely wrong in either of my rant, I'd love to hear your own rant. Rant away in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.